phone, of course. So, and why don't you you mind sharing a little bit of your background? Kind of what was the education or skill set that allows you to kind of do what you do now?
It's really an understanding just of numbers. I think you go through high school, college, whatever, and you start to do like crazy levels of math, whether it be calculus or whatever, and you get out into the real world and all you really need to know how to do is add and subtract and divide. And so I think that's it's an interesting, the skill set is for underwriting is kind of using both sides of your brain, is the understanding that you don't know everything and you're always going to get something wrong, but then the ability to like get as much right as you possibly can. And so I think for a lot of people that scares them is that, hey, if I don't get everything right in the underwriting model, and it's not a perfect model, I can't do the deal. There's never been one underwriting model that has ever gone exactly to pro forma, and it never will. The only perfect model is the deal that you never do. And so you can get a lot of paralysis of analysis, right? And so for me, my background was from the South Side. I went to Center Grove, went to IU, got an accounting degree, knew I didn't want to do accounting as I was getting that degree. I knew I wanted to be in real estate. So I started my career at Simon, went to JLL, and I've been at Birge and Held for about 4 years. And all of that time, I knew I wanted to work on deals. Same reason why all you guys are here is that transactions creates volume and creates wealth. And the idea that you guys want to create wealth through passive investments, and while you're sleeping, you're generating income. I think that's probably why everybody's here. And so that's what led me down the career path that I chose.
Nice. So there's so many variables when you're underwriting, but what's like the one thing that you guys look for? Like if this is off, it's a no-go.
Yeah, the market. You can do a marginally successful deal in a bad market, but you can't hit home runs or do sustained good deals in bad markets. And so what I define by a bad market is a shrinking market. Is population subtracting rather than increasing, or income's going down, or the demographics, is the population not only shrinking or the income going down, but are there certain submarkets in that market where people just refuse to live for any given number of reasons. And so understanding who your population base is today and who you project that population base to be in 5 years or whatever your hold period is, that's what separates good deals and bad deals.
Gotcha. And are there, so market growth for sure. I mean, are there other things you look for? Schools, crime,
Yeah, that's a great point. So the school system is a big deal because people only, and crime is obviously another big deal, but also then access to interstates is something that we look at a lot. And so the school system and that access to the interstate we own about 3,000 units in Indianapolis, and all of them are probably within a mile and a half of 465.
That's interesting.
The reason why is because if you're close to 465, you're within 25 minutes of 2 million people. I live in Avon, and it takes me 20 minutes to get to 465. And so that itself isolates, right? And the school system is because people only live in a place because of either a job or their family. And usually a family includes kids. And so those are the two primary drivers of housing demand. And the primary driver of also keeping your basis or your value of your asset where you want it to be.
How much do you take into account like a Whole Foods, a Trader Joe's, Starbucks, kind of a path of progress thing, or is that not as applicable to with your guys' focus?
Yeah, it's
asset class.
It definitely is a focus. We talk a lot about, I have a retail background. One of our two principals has a retail background. And the retail guys know the best demographic information, and they're the smartest when it comes to where a store should be. So if you see a McDonald's or a Taco Bell go up, you know that's probably a good spot to be in. That's a growing area. And so you mentioned Trader Joe's and Whole Foods. That's the path to progress that makes a lot of sense, because as retail grows, that creates housing demand, because not only is the retail, specifically a grocery store, they're counting rooftops, right? And so they're looking at the number of rooftops and the number of people to go into their store every single day to make sure they can sell as many goods as possible. Similarly, we're looking at how many people want to live in that area that's drafted off of retail growth, so that it can project out that future population.
Interesting. Do you guys have any questions? I don't have to dominate here. Any questions from the audience? If not, I got a list, but you can.
For the retail growth, do you take into account when these new buildings are coming up, new companies? Do you rely on the fact that they've done their research before wanting to build a Walmart or wanting to build a Trader Joe's?
Yeah.
And you can just kind of trust that they, being such a big company, they know what they're doing.
Yeah.
You can leverage that.
That's a good, 100%. I mean, if someone's building, or not someone, if Walmart's building a store, they're going to spend $25 to $50 million. And I don't know the last time a Walmart just went out of business. So any store.
Yeah, I was gonna say, especially like tertiary cities, right? Like in the smaller towns, so if you're a lot of mobile home park investors, because a lot of those are located in small towns, will go by the rule of thumb, like if there's not a Walmart, I'm not investing there, right? So that's one of the first things they look for, because Walmart has said, of the 10 small towns in this area, we think this one is the one that's going to make it, and that's why we're putting all our Walmart there. So yeah, I think that's great.
Where do you look for your market data to show for the trends in population, income, things of that nature?
Yeah,
we can go to Google easy enough, but I'm sure you guys are a little more sophisticated.
Yeah, Kent and I were talking about that. So we use a lot of tools that are really expensive, and one of the main ones is called Esri, which is just a demographic tool, but it's all pulling from the same source. So things that are available would, just your Census Bureau data, Bureau of Labor Statistics. We go there on almost every single deal to get your unemployment rate, to get your population. What's nice is the government will provide easy downloadable graphs, so you could see the workforce population for the last 25 years. City data, bestplaces.com I think is one of them, and I forget there's a school app or the school website.
What is that? There's a school rating site.
Yeah, to where you can get we did a deal recently in Fort Wayne where it was hey, what does this submarket remind you of? And I thought I try to equate everything to the local market that you're in. It's I think it's like this high school. And we went on the school ratings website, and they were similarly ranked in the state of Indiana. And so a lot of people spend a lot of money and government agencies, quasi-government agencies, to provide this data, that you don't have to manufacture your own data. And Matt, you mentioned Google. We've done over 50 transactions and a couple $1 billion worth of transactions since the company's been founded, and we still Google everything.
Yeah, the Esri is awesome because it's an aggregator, right, for the guys. So you pay because everything flows in and it's at your fingertips. For the average Joe, you got to do a little more legwork, but you can still, even Esri does have a free membership that you can get. I've created graphs, or not graphs, but charts of overlaying census data over Indianapolis. So I took, and I did have to pay for this, but all the apartments in Indianapolis over 50 units, and overlaid them all on a graph, because I could upload that into the software. And then on top of that, overlaid the census income data, so you can see where the apartment is and what's the income in that area, right? So if you're targeting, like, if you're targeting apartments and you want to be in like a solid B class area, and you probably want to look where people's income is in like the 60 to 90,000 range, for example. So like I think that's a big thing. We were talking about this earlier too, but you can't underwrite every deal because it takes a long time to underwrite a deal well. You've got to, I call it like the Tinder swipe. You have to be able to be like, yes, no, like really quickly, because you need to look through 100 deals and underwrite like 30 of them, maybe. So I think doing things like that to be able to get that data and understand right away, just based on where the apartment is. I think some of the info that Aaron gave was great, like near highways. I mean, you could really quickly say yes or no. And you got to get that good at it, because you just have to look at so many deals.
Mm-hmm.
Do you guys have any other indicators that you use as swipe left, swipe right, or this is a good deal, potentially a good deal, this is not something we even want to take the time to pursue further?
Yeah, for us, the next after you go to the market would be the physical bones of the asset. And so when you talk about an asset that was built in 1965 has different bones than an asset that was built in 1995. And so what kind of wiring is there? What kind of mechanical systems are there? Supply lines, whatnot, right? And so the piping, and but also, when was the last time the roofs were replaced? When was the last time, like, driving the asset, understanding all of the physical needs? Because all of a sudden, let's say you're buying $1 million asset, and you underwrote that you're going to spend $200,000 of capex, and then you get a bid back from a GC and it says $600,000. Well, now all of a sudden to get the same yield, your rent has to go up $50, and now you're starting to look at an affordability issue. So the next thing from the market for us would be the physical bones of the asset.
Yeah, I think one of the most important things is like understand the plumbing. That's the thing that will kill you, because that's the thing that will be like the hidden like $50, $100, $150,000 expense. Like if you buy things that were built kind of mid 70s earlier, you're gonna have like corrugated steel drain lines, or cast iron, or even like clay tile. And the problem with those is that they clog and break and back up. And it's not a question of if it's going to happen, it's when it's going to happen. So if you're buying an asset from like that vintage, I would highly recommend that you pay to get a camera in those lines and make sure you know what you're getting into, because like I personally know 2 friends of mine that own apartments that have had $50,000 plus issues just from a supply line backing up because it was corrugated steel. And that really eats into your bottom line when you have to take a $50,000 slug that was unexpected. So plumbing is definitely a huge thing. Let's see. So this one, I wanted your perspective on this one, because this is like a personal plant. When you're going through the acquisition process and you're working back and forth with a broker, right? How often are you talking with that broker through the process? What kind of information are you sharing with them? Because there's a certain balance, right, of keeping your cards close to your chest, but also, trying to share enough to make them confident and also get information from them at the same time. So It's definitely a balance.
Yeah, that's a really interesting question. The assurity to close is the broker's number one issue, and so that's a tough nuance to say. Actually, on the way over here, I found out that we lost a deal because someone was going to close in 40 days and pay $25 million all cash. You can't compete with things like that.
Right.
And so what you want to do on the communication with a broker is you want to talk to them, I would say, every couple days at a minimum. Silence starts to get really annoying. You want to understand, more so than anything else, is who else is bidding on the project. Because a broker, especially one that you've developed a relationship with, will give you as much information as they can trust you with. And especially if you've shown up and bought a deal from that broker before, they'll start to share a lot more information with you. And so you'll start to get an understanding of, hey, am I competing with 6 folks or am I competing with 2? They'll never tell you if you're the only one because they want to keep pushing the price up. But I'd say every couple of days, and what you want to do is you want to share your CapEx plan with them, and not give them everything. Hey, this is exactly what I'm going to do, but just ballpark, right? Like a broker and a seller wants to know that the investment that either they built or that they currently own, that someone's going to take care of it. You might be buying a deal from a developer that it was their baby, and so you want to share that you're investing in the asset, and then you want to share that also, like they'll ask you, like, what's your capital stack look like? What's your equity look like? What does your debt look like? And there's a lot of nuance to that you want to work through, that you're not, hey, I'm going to syndicate this, I don't know where it's coming from. And it's like, well, there's ways that you can answer that without saying it. So instead of saying, hey, I'm going to syndicate it, I think my brother-in-law will do $100,000. I think he's got a couple of buddies. Will say, I've talked to a lot of investors that are interested, and I've got X number of soft commitments, or I've got X number of commitments, and whether or not they believe you or not, I'm not saying like, hey, don't stretch the truth. You have to have like confidence in your ability to execute, or you'll never get a deal from that broker again.
Right.
But you still want to be able to project confidence in the same way that you share information, as opposed to, there's different ways to answer that question.
Yeah. I think the confidence thing is huge though. Like you definitely don't want to be hemming and hawing.
Right.
Right. Like that. So you say a surety to close is number one.
Yeah, absolutely.
Right. So that leads, like, you've just got to present yourself with confidence. If you don't, they're going to be doubtful that you're going to be able to pull this off. Right. So I think having a story, because I ran into that same thing. I was bidding for a larger apartment, kind of same deal. Didn't win because somebody came in and paid all cash $1 million more than we were even talking about. But we had to fill out a questionnaire. Like we got the best and final, and so the broker asked us to fill out a questionnaire for the seller. And one of the questions was exactly that: where's your capital coming from? And so the way that I answered it, because we were going to syndicate it and we didn't know exactly where all the money was going to come from yet, was that, I basically framed it as I'm part of an investment group. It's on my list of investors that, collectively have this much, and, kind of talked about it in that way, So, and then I talked about I kind of, you want to answer, but sometimes giving too much information can also be bad, because then you seem like you might be, trying to hide something. Like, keep it short and sweet if you can be short and sweet. So I quickly pivoted to like, here's the other deals that we've done and closed, to try to give, again, assurance that like we're going to close the deal. So what would you say? So assurance of closing, what's next on their list of what they're looking for?
Well, obviously price. A broker gets paid a percentage of the price that you're paying. So anytime, so a surety closing, price, and then deal terms. Someone that gets in and can do their due diligence in 21 days instead of 30 days. That provides some surety to closing. Hey, I'm just going to get through this asset. Then I would say the less contingencies as possible. And so obviously I think all of us would say, like, financing would be the contingency. Like, I've got to go raise some type of debt unless you're going to pay it all cash. So I think like to not have so many contingencies to where it's like, hey, I need this, this, and this to happen, and then I can close. I think that in that order.
That's helpful. You guys have, anyone else have a question? Yeah, go ahead.
Aaron, normally are most of your deals sourced through brokers?
Yeah, I would say 95% of them are. We're doing units from 100 units to 1,000 unit deal size. And from a capital standpoint, the deal would be $4 million and above. And so most of those deals are broker and or they are us talking to, sometimes we'll talk to a seller, but the deal size drives a broker, but also the type of market that we're in right now drives a broker. Is if I'm selling an asset and there's so much capital that's available right now, it's really hard to justify as a sponsor to go to your investors and say, yeah, I'm not going to list it, we found somebody off market. Because the amount of foreign capital that's out there, the amount of 1031 exchange capital that's out there, you just don't know who's going to show up at the offers and the first kind of cattle call for offers. And so we sold 3 deals this last year in Indianapolis, and the top 10 offers were all from out of state. 5 years ago, that wouldn't have happened. However, there's just so much capital flooding into the multifamily market that had we not listed that asset with a broker, we might have lost millions of dollars.
Yeah, I think that, I mean, the rule I've always used, and maybe it's even less now, but like at least 100 units and up. I mean, those guys are sophisticated enough that they're not going to, like, cold calling them typically does not work, right?
Yeah.
Like because usually it's not one guy that owns one property, right? It's a company that has probably thousands, and so the cold calling approach probably won't be successful. On smaller units, I haven't done it personally, but I mean, 9, 20, 30, like I know people that have had a lot of success on just cold calling directly to the owners. If you can kind of figure out, who's behind the LLC and do that way. So just different approaches I think you need to take depending on what your focus is. The larger stuff, don't waste your time cold calling, don't waste your time, but use your time building broker relationships. And that's the biggest thing, right? You said that. You said if you have a good relationship and they're going to give you information because they trust you, that information is critical to being able to close the deal and know your environment and know where you need to be, right?
Yeah, absolutely. I mean, I think you said it well. Like on the small deals, if you're not doing 100 units up or whatever on deal size, I mean, most of the marketing that someone that owns 4 units or 8 units, they stick a sign out front that says, call here to rent. Call that phone number, and then you start to have that conversation. Usually, it's someone that's related to the person that owns the building or has a really close relationship with that person. Say, hey, I'm not interested in renting an apartment. I'm calling to see if you would be interested in selling this asset. And if you get hung up on 95% of the time, I mean, you at least get one answer to be yes.
You only need one.
Exactly,
Yeah.
and it takes 10 to 30 minutes of your time. And usually those phone calls are pretty quick.
It's a good tactic, especially that click.
Yeah, exactly. Yeah, exactly.
No, that's a great tactic. I had one last question. It was around, so I think another thing that's been driven by kind of where we are in the market is the idea of the best and final, or like the best and final, or like 2 or 3 tiers of it.
Right.
So how do you think about that, like the strategy around your initial offer, understanding that most likely there's going to be additional rounds that you're going to have to continue to tighten the screws on? Like, how do you approach that?
Yeah, that's interesting because, as you mentioned, there's not only sometimes there's a first round and a best and final, but there can be 3. And a lot of times the best and final, you fill out a questionnaire and then there's a phone call. So if you're lucky enough to get one of 3 phone calls to say, hey, I want to do an interview with the seller, usually or sometimes on that phone call is like, well, the broker will say, is there anything that you could do to sweeten the deal? And it's like, so like in the moment you have to be like, yeah, I could raise my price $50,000 if you give me the deal before we get off the phone, right? I mean, there's always 2 sides of it, right, to negotiation. And so the way that we play the original is, again, develop the broker relationships to where you know where you need to be in an offer to get into the best and final. Because the more time that you spend prior to best and final to give the most information to the broker, it allows the broker then to talk to everybody else and kind of pit you against all the other people in the best and final to raise the price. And so it's like, hey, where do you think offers are coming in at? You never want to submit an offer a day and a half before the offer's due. You want to call the broker the morning of the day that the offer is, say, hey, sorry, I'm getting behind. I mean, this is obviously assuming that you have a relationship with this person. Don't do this like the first time and don't end up writing an offer. That would just annoy them, right? And so once you develop a relationship, you've worked with them enough, you submit an offer 3 p.m. on the day that it's due. And there's been many times where we've gotten a phone call where it's like, that's not even worth the paper it's on. It's like, okay, well, where do we need to get in the best and final? And usually they say, well, I mean, the cutoff is going to be at this number. And then you can quickly go to your underwriting model and say, hey, does it even make sense for me to even be at that number? If it does, say you resubmit an LOI. And then you get into best and final. And in the best and final stage, what you want to do is you'll want to tour the asset a second time and usually it helps to bring somebody else to say, hey, I'm walking this with my contractor because I'm tightening my numbers on my CapEx, yada, 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 right?
Mm-hmm.
And so then they start to see how much time you're spending on it. Like, brokers are extremely observant individuals. And so all of these things, and you set yourself up to potentially win a deal, as opposed to the guy from New York who's never toured the asset, but he's at the same price as you. Usually a seller's willing to work with you if they know you've put the due diligence in, because then that goes back to the assurity of closing. You're not going to find a plumbing issue because you've been at the asset 2 or 3 times, and you should have found that by now. But the guy that's never came to the asset and just says, yeah, I'll pay this price, usually what happens when you start to get into contract negotiation, they visit the property the first time. It's like, oh wow, we found all of this stuff, and then you start to retrade, and that's what ends relationships very quickly, is to not be honest up front, and to then retrade people and say, yeah, I did all my due diligence, and then when it turns out, no, you didn't do anything.
Yeah, I think that's great advice. So my takeaway is you could actually win with a lower number, but a well-defined CapEx budget, outlining everything about the property that's wrong, that's justifying your lower number, versus somebody with a higher number who, as you said, hadn't seen it, who's probably going to now try to retrade on that number because their CapEx budget is going to end up like yours.
Exactly.
Right?
Exactly.
But you've done it up front, and that gives, again, a surety to close.
Exactly.
Confidence.
Yep.
Very cool.
So, Aaron, you mentioned due diligence. I know we're in a good market now. When you're looking at deals now and thinking about acquisitions, are you stress testing them as if the market does not continue in the way that it has been, or what are some ways that you are stress testing your deals?
Sure. The best way to stress test a model is, are you going to achieve the rents that you think you're going to? So you think you're going to go in and do $5,000 a unit of a rehab because you're going to do new appliances and new flooring and what have you, and we're going to get a $150 rent bump. Well, it turns out that you get a $45 rent bump. What does that mean for your cash flow? So that's one stress test. Another one, specifically on smaller unit deals, is the occupancy can waver extremely quickly. I mean, you're doing an 8-unit deal, and you know that you can be cash flow positive as long as you have 6 occupied. Well, what if you have 3 months because you have 4 because your contractor isn't as fast as they promised they would be, and so now you have 4 units down for 6 months. What does that do to your cash flow model? So occupancy, rent bumps, and then the next thing that we stress test the most, it would be debt. Understanding the biggest expense you're going to have is your principal and interest payment to your bank. And so how much room do you have before you start to be cash flow negative in the interest rate? And can you fix your interest rate? Or are you going to float your interest rate for 5 years and assume that they'll just stay low? So those are the main ways that we stress test our models, and I think regardless of asset size, those will hold true.
Do you guys ever, to get an idea of like rents and stuff, will you act as if you're a potential tenant and call other properties to get an idea of the market?
Yeah, that's a good question. Yeah, we do that with varying success.
Okay.
Showing up and
Mhm.
I mean, it's pretty obvious, like if you're like looking to actually rent an apartment or not, because like all of you guys would start asking a bunch of questions that someone that wants to rent an apartment isn't like. It's like, well, hey, when are you looking to move in? And it's like, well, yeah. And so like, it becomes hard. The easiest way, honestly, is to go to people's website. We use apartments.com, and so like there's their specific assets website is the best way, because I mean, just like anything else, an apartment rent is posted on anybody's website, and so you go there and figure out, hey, they're renting a 1 bedroom for $689, and we think we're going to be at $759, and they have a much nicer unit. Maybe we should rethink that.
Yeah, so I've done the same thing. You know, kind of create a script and then just call all the people around it. Also go and visit them. So if you're touring the property, like whenever I go tour a property, I try to tour all the properties around it too, because that's the best way to understand your competition, what their finishes are like what do the interiors look like, what kind of amenities do they have, how clean is the property, right? And then what rents are they getting compared to the property you're looking to buy. So I mean, that's the best case study to what is actually achievable, is like, what have the people already done around you?
I think that makes sense too, if you're gonna go in and rehab a bunch of units, and then if you match what someone else has done, and you can see what their rents are, you go like, okay, now I'm a little more confident that we will get the rent bump
Yep.
that we want.
Yeah.
Another thing I actually heard on Rod Cleef podcast was the guy will go to opposing properties and ask them about the asset he's looking to buy. And they will know all the dirt about why some tenants are leaving there to go to their properties and stuff like that. So you can get a better picture of the asset you're looking to buy based off of what other people in the area have to say.
I've found that property managers love to spill the beans on opposing properties. Yeah. Especially if they're right next door. They'll be like, oh, we have people coming from over there all the time causing trouble, or whatever. And you gotta take it with a grain of salt a little bit. But I found personally, like some people will say like go in and act like you want to rent an apartment, like show up. Well, like I know that if I show up at a C-class apartment, they're not going to be like, this guy's really here to rent the apartment. Like just not the reality. So instead of trying to be fake about it, I just walk in and say, hey, I'm an investor looking to invest in the area. Like, I'd love to learn more about the area and about your property. And I found that people are very open to tell you all about it and tell you. I mean, I've had property managers of other properties tell me, these are the type of renovations we're doing. Here's how much rent we're getting on them. Here's what works. Here's what doesn't. Here's the amenities. They'll be like, oh, people here, like 70% of people around this area have dogs, so like dog park is huge. I think like you get tons of information, and I don't think you have to be fake about it. I think you can just be honest and say, hey, I'm an investor. I'd love to learn more about it. And people have been pretty open. I imagine you probably get some doors slammed in your face, but I haven't yet, luckily.
I think it's different in the kind of markets that you go into. Like if you're in a bigger, like an indie market versus like a tertiary. I think sometimes people who are in tertiary markets are like, whoa, right? So you kind of have to, I think, play it to your advantage, I guess.
Yeah.
You're right. Like you go into a, C- class asset, like, hey, I want to rent.
Like, I was driving an Audi at the time, so it's like drive up in an Audi and get out and be like, I want to rent an apartment here for $650. Like,
you gotta bring your beater next time.
I know. I want to get one, actually. My wife won't let me get one. I want to get like an 80s truck, just haul stuff around with, and she won't let me. But that's a different story, guys. Any other questions? This has been really good. Otherwise, Aaron's going to walk through an actual deal for us, and I think that'll probably generate more questions as well. So just go there.
Yeah.
Sorry, I came in late. I was hearing a lot about using the price per square feet as far as better more than the rent. Is that something you look at necessarily, or just kind of go like 2-bedroom rent is this, or do you kind of look at the price per square foot?
Yeah. So not only price per square foot, but price per unit is something that we focus on a lot. So One of the main metrics that we look at is what am I buying it today at replacement cost against replacement? What could it be built for? And in 5 years, am I selling it for lower than what I could build it today? And you want the answer, both the answers to be yes, because I mean, the asset that you're buying was already built. It's obviously inherently going to be older. It's going to age as you own it, even though you're doing a rehab. And so you want your purchase price on price per square foot and or price per unit to be lower than what could be replicated today. And I think that's a very important thing that we look at, not only because then ultimately you're just taking your rents and your ultimate income divided by that to understand what kind of yield you can actually attract.
Do you think that's a good way to compare different assets?
Yeah, I do. I do think it's a good way to compare assets.
Do you guys look at like a gross rent multiplier?
We do. Appraisers look at gross rent multiplier a lot, and so effectively understanding how much rent can you get for that given asset is an extremely important metric, and it's something that we look at because I was looking at one the other day, and there was a range from 9 to 12, and there's different reasons based on the space of like why certain rents are what they are, and so that's all part of comping out of hey, this asset was built in 1975, but it has washer dryers in it, versus this asset was built in 1983, but it's smaller unit sizes, and you have to do your laundry in the clubhouse. And so to understand all of those nuances, to then understand ultimately why do assets price the way that they do, is just a heavy part of the underwriting process.
Very cool.
I got one question real quick.
Yep.
Outside of Indiana, what markets would you say are similar to Indianapolis?
Oh, that's a good question. So for us, we like markets that are similar to Indianapolis, and we think of Indianapolis as a whole as an economy of the biggest employer is Lilly, and there's also multiple hospital systems. So it's also a state capital, and there's also a major university in downtown Indianapolis. And so what you have there is healthcare, education, and government being the three main foundations of this economy. And so we looked at similar markets. Columbus, Ohio, we think is a little bit stronger of a market than Indianapolis because instead of IUPUI, you have Ohio State. We think of Louisville, Kentucky. It's not a state capital, but it's the largest city in Kentucky. It also has multiple universities in it. We're in Denver, Colorado, and Minneapolis, Minnesota. Minneapolis has University of Minnesota downtown. It's also a state capital, a financial regional capital, and has really good healthcare systems. And so those are what we look at outside of just Indianapolis, of how do we think a market is similar to Indianapolis is, who are its biggest employers? Because ultimately jobs drive the demand for housing, and that's why people live in a market.
Onto that note, real estate's kind of known for being like segmented, and with technology and stuff and social media, you know, do you see it being less segmented? Do you see more cities kind of coming together and being more similar, or do you see it becoming more segmented?
Yeah, it's interesting. I don't know that I've thought about that. I think more cities, I think you're starting to see like the have and have-nots of cities, to where, yeah, you can work anywhere and you can work from a laptop. You can work, it doesn't matter what your physical location is as long as you have Wi-Fi network. However, from a social aspect, not nearly as many people will want to live in Indianapolis as Denver, and that'll never change because we can't drive to the mountains to either ski or hike given the season. And so I think what you're describing is that from a social impact standpoint, that the demand for housing and the demand for housing pricing really has to do with why do people want to live there, and it's a quality of life thing. It's the same reason why more people want to live in Indianapolis as Fort Wayne. Not only are there more job opportunities, but there's more to do. And then you start to go out into like the tertiary bands. The deal that we're going to talk about today in Kokomo we never thought that the rents were going to be the same as what we get in Indianapolis, because there will never be the demand for housing in Kokomo as Indianapolis, regardless of what happens at the local government level.
Cool. All right, let's get into it.
Awesome. As Kent mentioned, I mean, I'm learning every day just as much as you guys, so, I mean, stop me. I mean, this is what I do every day, so I might start going really fast, and you guys just raise your hand, and, I mean, ask as many questions as you want. By no means do I know everything, and I would love the interactive nature, so,
Look at that. Tech worked. Figured it out.
yeah, very good. Very good. So, this asset, Maple Crest Apartments, it's 149 units in Kokomo, Indiana. We'll get back to this, but the story about this asset is it was built in 1962 and 1978. In between those years in 3 phases, we actually bought the deal from the son of the developer. And so that brought some interesting characteristics I can talk about later. But since we talked about it, when we're out raising equity, myself and the 2 principals of the firm, we always talk about this slide. And we were talking about rents earlier, and how in the world do you underwrite a deal? Well, the first place it starts is, what rents do you think you can charge? And so what this slide is, shows, and I'm sorry about the, probably hard to read, but our average effective rent was $617. You can see that right here. And so this graph is a lot easier to read, but here is the current assets rents, and this is where we're taking the current assets rents. And these are all of the current comps in the market for any renter in Kokomo. You can see that we're not taking Maple Crest rents from $617 to $930, and we're going to be the most expensive people in town. That's not a legitimate underwriting scenario. So you have to understand what your asset is and why the rent's priced today with what they price. If you don't understand why the current rents are what they are, then you're going to have no idea why your future rents are going to be what they are, if that makes sense.
What's the biggest factor that drives Legends of Wildcat being at the top versus anybody else? Is it just the age of it, or what's the biggest thing?
Yeah, it's not only the age, it's the finish level. It's whether or not they have washer dryers is probably the biggest thing that we look at from a finish level standpoint. It's location, and so all of those factors. And so to that exact point is Maple Crest was built in the 60s and 70s. Legends of Wildcat was built in 1999. They're both 95% plus occupancy. Legends of Wildcat on average offers 127 square feet more than what Maple Crest does. And so inherently the rents should be higher. And that's another thing. And so for all of those reasons, age, finish level, location, size of unit, the main things. You talk a lot about an investing price per square foot or effective rent per square foot. No one ever, and those are really important metrics for investors such as ourselves, no one ever renting an apartment has gone into a leasing office and said, what is your rent per square foot? They want to know how much rent is coming out of my checking account each month to pay for rent. And so all of these really important investment metrics that we were talking about earlier make sense to us, but they're never going to make sense to someone that's renting an apartment or living at your community. So understanding what's important, and that's why we start out here looking at this chart of a graph or a table that says, hey, what are my rents today, and what can I realistically move my rents to?
I think charting it out like this is just genius, because I learned this from you guys. I've invested in a couple of their deals, and because like what I found personally is it's really hard for me to interpret anything from that table. But when you graph it, it starts to make a lot more sense on where things are and where things can go. Because when you're trying to keep it, like he was saying earlier, when you're like, well, this one was built in 75, but it has washer and dryer, and this one was built in 90, but it doesn't, and this one's 50 square feet more than this other one, you start to, well, where should the rent be for either of these? I don't really know. It's hard to keep all that straight. When you start to plot it though visually, I think it does start to make more sense.
Yeah, I think that's a really good point. To add on to that, no one looking for an apartment is going to go and tour 10 deals. We might as an investor, and you should. However, I mean, who has time to do 8-hour-long, fill out an application at 8 different places, go and tour and look at the model unit? People that need an apartment don't have that much time. It's just the fact of the matter. A lot of them don't have a flexible work schedule, right? And so for us, when we're focusing on workforce housing, people that are making a family that's making anywhere between $25,000 to $55,000 for the entire family. And for us, we try to look at, for those reasons, the 2 closest comps. What are the closest comps to Maple Crest? Is it Turtle Creek and Barcelona? Well, looking down at this list, Barcelona is a really good comp because it was built around the same time. We have larger units, but their rents are about the exact same. And so because it's the closest asset to us and it was built around the same, I can then isolate 2 variables. I can say, hey, these are basically the exact same. Now what I need to do is look at the finish level, because now I know that we're built the same, we have the same location, the rents are the same, so then how can I differentiate myself? And so understanding even within the comp set that this is an entire market, that you want to understand exactly who you're competing with, because people aren't just going around the entire market and saying, hey, I think I could live at either one of these 12 places.
Just from recently touring a couple different deals, more of as a renter than, but especially as you get into the larger asset classes, like 100 and above, even into like the 300 and 400 unit space. Are your guys, or you guys specifically from a company standpoint, do you guys use like an algorithm or anything like that to change the rent amount based on demand? Because that was something I was seeing, like, you go in and be like, oh, well, it's 800, right? And then based on, okay, well, if you come back, next week, it's going to go up. Do you guys do something similar there?
We do. And so based on law, you can only you have to offer the same rent to every single person for the same unit type for 1 day. And that's another reason why I think a lot of people were having a class like this, and why everybody's so interested in multifamily investing is the ability to change rents and what that can do to absorb any inflation in the market. And what I'm saying there essentially is that if you were to own this, or if you were to lease this office space, the rent changes once every 3 to 5 years. Well, if you're running an apartment, your rent will change once every 12 months, and so we're able to capture inflation bumps every single year, which makes it a better asset to invest in because inflation isn't eroding your yield as much, right? And so for that reason, there are tools that we use that say, hey, based on the demand in the market, and it'll run an algorithm, hey, we're going to pool 50,000 units that we have access to in the Indianapolis market, and occupancy is this, and we set a rent floor, and we set an occupancy floor, and says, hey, your rent should be $800 today. You and 3 of your buddies come in and rent 4 different units, and then a week later someone comes in and says, yeah, your rent's going to be $875 because I don't need to fill as many units as I once did. And so that costs like $5 a unit a month. And so I would recommend not doing that until you know that you know your pricing cold, right? And so that's the whole, we'll get into it more, but especially at small units, unit count for a deal, or really any deal in general, the person that's sitting in the office leasing units is the most important person. And if you can't trust that that person is making good pricing decisions and has the flexibility of what price to offer based on what the future rent roll looks like, then, I mean, your pro forma underwriting model is worthless.
Sure, that makes sense. I mean, obviously on a more sophisticated level, you're gonna have that, but in, 8, 10, 12, 20, you're not, that's not something that I've seen in the past.
Yeah, yeah, that makes sense.
It's just too expensive. The software is just
Mhm.
too expensive.
Yeah, I mean, I
at
would
that level
imagine.
now.
Yeah.
The scale to make it worthwhile.
Sure.
Yeah, that tool by itself is $4 or so a unit.
Mm-hmm.
And when Birge and Held first started, we were using Appfolio, which is a software.
Yep.
And it's $1 a unit for, you think about that, and that does all of your accounting, that does all of your payments, that does all of your maintenance. I think it's a really good tool. And that's $1. And then we're just talking about pricing metrics, it's 4 times that. And what do you get out of that? It just is too expensive.
You start to see funky stuff though, like you see a 1-bedroom that's more than 2-bedroom.
Yeah.
See weird things. Like if you're ever on apartments.com and you see that, it's because they're using that software.
Mm-hmm.
The demand for a 1-bedroom is higher than 2 at the time.
Yep, that's exactly right. So I thought I would, let me pull up my notes on my phone so I don't just miss anything. So I'll just start from the very beginning. Again, stop me whenever, but this is our normal pitch book. And so this is more on the equity raising front, so I'll kind of just like gloss over this because I know this is more about underwriting, but when you raise money, you really need to tell the investors what they're investing in, and you should have like a really clear understanding of what they're investing in. And so we talk about the asset overview and the business plan in 2 slides and a couple tables. And we have a summary email that talks about exactly what they're investing in. When you start to get really long-winded and flowery and starts to talk about really all of the underwriting details, you just lose them. They're investing in you because they have confidence in you, not because you have the most perfect pro forma that has the coolest formulas, okay? And so keeping it simple is really powerful from an underwriting standpoint. The sources and uses is a very important slide. It talks about exactly like how on earth are you going to be able to buy this deal. And so here you have your source section of your first mortgage. You've got investor equity and debt. And then this use section is all of your purchase price, how much money you're going to spend on a renovation plan. All of your closing costs are wrapped in here. Your acquisition fee, don't forget that one. And all your other contingencies, all of your other costs. And so what's interesting is people are like, yeah, hey, I bought that place for $8.4 million. Well, based on our plan, our total basis is going to be $9.6 million. And so based on transaction costs and our rehab, we're going to put $1.2 million in it. And so it's really important for you to understand your actual basis in it, so that you know how much equity you need to raise, because you have a fixed debt amount, and you need to know if all of a sudden you think, hey, I bought the place for 8.4 and I'm getting 6.7 million, and from the bank, I need to raise 1.7 million. Well, for one, you forgot to pay yourself to do the deal, and for 2, you don't have any money to do your rehab program. And so to work through and understand all of the costs of an acquisition, you need to set up a source and use to balance it out and make sure they always balance.
I got a question. So like when you're looking at a deal and you, like let's say you really like the deal but you don't have enough funds yet from investors, what do you kind of do there? Where do you like the process to be? Do you like to have the investors already have the money there while you're looking at deals, or do you want the deal first?
Yeah, you got to win deals to attract investment, right? So it's really hard to talk to investors about a deal that isn't captive, that you don't understand. Or not that you don't understand, but that you don't have under control, right? And so it's like, hey, I think, for example, just, hey, I want to go out and see the asset that you're telling me about. It's like, oh, well, let me call the broker. I don't have it under control, and we'll have to talk to the broker and we'll see. that then loses confidence from your investor, like we were talking about earlier, presenting confidence to the broker, but also to your investors. They were like, hey, yeah, we're going to go see the deal. I've got it under contract, or I'm in best and final, and I think that we can win it. Do you want to go see it? But having an understanding of where you're at in the process, and like knowing that you potentially could have it under control, even if you don't at that exact moment, is a really important thing, because investors, specifically high net worth individuals that are looking at 100 different offerings from people, only want to spend the time on ones that they know that they might write a check on. And so they want to know that you've done all of your due diligence and everything's buttoned up before you kind of have a conversation with them about writing a check.
I think my only caveat there is if you're getting started and you're raising money more from like friends and family, you need to start talking about what you're going to have to start talking about what you're doing before you have a deal. Otherwise, there's going to be nobody there to invest in your deal, right? You got to start talking about what you're doing, talking about your business plan, even, what I did and what I know others have done is just get a sample deal, find a deal from a broker, underwrite it, put together a package like this for it. It's better than nothing. And you're at least talking in concept, and what you say is, essentially you use the deal to walk them through what you're doing. You say, if I brought you a deal like this, is this something you'd be interested in investing? Right? So basically you're framing your box. So I'm looking at, workforce housing built between, 1980 and 1995. That's anywhere between 10 and 50 units in Indianapolis, being as specific as possible. Because it is a constant balance. I think Birge is in a much different situation where you have people beating down your door. You guys have like 2,000 investors.
Sure.
Right?
Yep.
For folks starting out, it's you're going to have deals and you're not going to have any money, or you're going to have money and you're not going to have any deals. And hit that balance is critical. So you got to keep your investors warm by communicating with them regularly, and telling them what you're doing and getting them interested in the concept, so they're not totally blindsided when you're like, "Hey, Uncle Tom, you want to give me $100,000 to invest in this apartment?" And they're like, "What? What are you talking about? I thought you worked at Lilly or something." You know what I mean? So you got to get them warm, keep them warm, and then so when that deal comes, there's people there that you can put together.
Yep.
Otherwise, you'll run into this thing where you're spending all your time getting investors, and you're not sourcing deals, or you're sourcing deals and your investors are cold. And when you go to call people, they're like, "I haven't heard from you in 6 months. I don't have any money ready." So it's just a balance.
Yeah, that's great advice. Yeah, I think that makes perfect sense. You need to always be in constant communication, or and a lot of times, as Kent mentioned, you're leveraging your current network, right? You're leveraging family relationships, close friendships or whatnot. And so I think, as Kent mentioned, going out and getting coffee with folks to make sure that they're interested in something like that, so it isn't a blind side. Hey, I need $100,000 by next Friday so I can close this deal. That becomes a much different scenario and puts you in a position to not be able to negotiate how you're going to get paid on the deal, right? And so all of that becomes a really important balance, and I think that Kent, you said it well. This slide that we have in our underwriting is probably the most important slide, and there is so much information on here. But as our Excel model has changed over 10 years, and I've been with the company for 4 years, this slide has never changed. And I think that was probably the most important and smartest decision that the guys made, was to never change your underwriting assumptions tab to where, hey, if you've invested with Birge and held 15 or 20 times, you've seen this slide every time, because this is exactly how the deal is going to be capitalized. the waterfall metrics. And so what we can walk through this one because I think it's really important to understand. And I think it's an important caveat that this entire PDF is an Excel template, right, that we've built over a number of years. To be a good underwriter, you have to have confidence in Excel. And it doesn't have to be the most sophisticated model ever, but what you want to understand ultimately is what is your cash flow every year. And so I think maybe just skipping over this slide, we could probably just start with how on earth do you build a 10-year cash flow model? And it's as simple as pulling up in Excel and you start to get line items. I mean, you can go on Google and say, hey, how much, what does a multifamily apartment operating statement look like? And you'll get 1,000 hits. And you just pull one down and you start to just pull all of the titles off. And then you start to make assumptions like, hey, based on the current rent roll, and I'll just start toggling back and forth, but like based on the current rent roll, this is how much income is coming in per unit, $616 on average. Okay, that relates to or equates to $33,598 per month. Okay, and so for the 149 units, so you build a simple table like this. What is at the asset? How many units are there? If you start underwriting the wrong rent roll, it's going to be really tough to have a good pro forma, right? And so understanding what the asset is. It's 149 units. This is the current rent that's being offered. I have a rent roll, so I actually know how much they're actually achieving per unit, okay? A lot of folks will have a market rent, hey, $1,000 per unit, but on the rent roll, the average rent's only $900. Well, you don't want to underwrite 1,000 because they're only achieving 900, right? And so all of that flows into one number. And so here for the 12 months, we're expecting to get $1.1 million of gross potential rent. And so that means if every single unit was occupied for all 12 months, that's how much money we could get at the current rent levels. Here is our vacancy factor. So you do an analysis of the market and you find out that you go and tour all of your apartments, right, that we talked about, and you find out that your 5 closest comps are all 75% occupied. You probably shouldn't underwrite the fact that you're going to be 95 because you're the best. That doesn't make any sense, right? So your asset will be a reflection of the submarket's health. And so that's why we talked about earlier, you can't do great deals in bad markets. If it's a bad market, you can't just be the best because you're going to run it better than everybody else. There's a reason why that submarket's metrics are what they are. And you have to figure that out. Okay, and so here we underwrote not only the submarket strength, but also when you're underwriting a deal and you have all the information from the broker, they'll give you 3 years of operating statements. And so what you need to go in is month by month understand what was their vacancy for the last 3 years. Okay, and so then you can start to develop that metric. Okay, so we thought it was 5%. Skipping down to another thing is bad debt. You always want to assume that life happens. These are people's lives. These are people's homes that we're talking about. The fact of the matter is someone's not going to come up with rent. And if you have to evict somebody, you're going to have to take them to court. And that unit, you're going to have to write off that rent for the remaining term. Okay? And so... And that's just a fact of the matter. I mean, when in our industry, in multifamily, 50% of the units turn over every year, okay? And so that means for someone lost a job, someone's job transferred, kid got into a different school, someone got divorced. All of these life scenarios change where someone lives. And because of that, you have to factor in that 50% of people are going to move out. And that would then relate to bad debt and other loss, because all of those life scenarios put a pinch on people's income. And so we'll get to more of that later.
Quick question.
Yep.
With all those scenarios and variables, doesn't 1.5% seem pretty low?
Yeah, so that was based off of the historical, like we would underwrite more so that the historicals would be reflected in the current resident base. I mean, I think 1.5% is about what our portfolio does. And all of those different scenarios play out, and as long as your rents are at the appropriate level, the bad debt should be moderated. And so, for example, what we like to underwrite is that if the current resident base is paying 15% of their income towards their rent, and you know all of their income because of a lease file audit that you would do, we want to make sure that we're staying within that bandwidth of what they're used to paying because of all those scenarios, that we can achieve the same bad debt that they've achieved over the last 12 months, 36 months. And so,
How does that play out though if the business plan is based on bumping the rents $150?
yeah, that's a really good point. And so what you want to do in an underwriting model for that reason is, if you think you're going to underwrite $150 rent bumps, you need to stress that, like we talked about earlier, of only getting $50 rent bumps. But something that we're doing a lot more is bumping it in a two-phase way. So hey, like I'm going to underwrite getting $150 for this unit rehab, but I might only get $75 the first time, and I might get $70 on the next renewal. And the reason being is because when you start to increase the rent bump, $150, $200, a substantial amount of the rent, you start to get into a really unique scenario where the current resident base and the new resident base are different. The demographics different. These folks are making $70,000 a year. These people are making $40,000 a year. They just live differently, okay? And so, and they don't always necessarily live well next to each other, okay? And so the ability to get top dollar for your nice brand new unit when down the hall the guy's smoking in his unit becomes more difficult, right? Or they're leaving their trash outside in the hallway, and you've got brand new granite countertops and LVT flooring in there, and down the hall, a guy's smoking a cigarette and putting it out on the countertop that hasn't been changed out for 25 years. It becomes very difficult to charge that premium. And so what we're seeing is a phase-in of the rent bump over a number of unit turns so that like an entire building can turn. And so, yeah, I'm actually interested. I'll go back and look at the bad debt for this deal. I'm just interested how it's performed. The next thing on an operating statement is other income. You get other income. Not only do you pay rent, but all of us I think have lived in an apartment at one point in time. We might live in an apartment now. One part that we're really passionate about is like debunking the whole negative connotation of apartment living. And I think you see in the demographics of America that owning a home actually isn't really the American dream, and most of the population doesn't think so. It was the American dream for community banks, but that was about it. And so instead, you see people that living in an apartment isn't a bad thing, but a lot of different people think that living in an apartment's a bad thing, and a lot of different jurisdictions, Zionsville just did it, a couple other places just did it. It's like, we don't want people to live in apartments. Like they can't afford to live in a house or pay $300,000 for a house, like why would we want them? It's like, well, that doesn't make any sense. I mean, who's gonna work everywhere? And so I say all of that because this other income is you charge people to run a background on them. You charge people to apply to your place. You charge people to have a pet at their apartment. All of that goes into other income. You also charge people for water and sewer, or if the electric is in your name because that's the way the building's wired, and you charge that back to them. All of that would hit an other income line. Whatever isn't rent hits the other income line. And if you're doing a good job managing your property, that's probably the most aggressive line item you can do in your underwriting model. because people will pay for ancillary services. For whatever reason, it's just psychological. People do not want their rent raised. But you start to throw in all these ancillary items, and it might be just completely made up. They're like, wow, that's a really good service, and they will never use it. That's why people rent at places that have a pool. I mean, I lived in an apartment complex that had a pool. I think I went to the pool 3 times, but it was cool at the time. I mean, right? I was a single guy, and I was like, well, this is great. I mean, this is gonna be awesome this summer. I mean, didn't work out. So.
What do you, on the amenities standpoint, like what are you guys targeting? If you're in a C class, for example, what amenities or services are you targeting versus B?
Mm-hmm.
How does it change? Are there things that you're like, we're not doing this, we know we're doing that?
Yeah, the biggest amenity B and C class for us is in-unit washer and dryer. And then when you start to go to your non-unit amenities, we look at, for us, I mean, this isn't an amenity that you can really control, but the availability of a bus stop. I mean, especially in a C-class neighborhood, and I mean, the underwriting assumption that everybody owns a car or has 2 cars for a family of 6 people, that's not true. I mean, so is that asset next to a bus stop or public transportation? We haven't done this before, but in other C-class areas, there have been folks around Indianapolis and around the nation that they have a daycare in the clubhouse. And I mean, that can be very expensive with the licensing, but it can be a really big benefit. Another amenity, so laundry, we talked about, daycare, I mean, a playground on site, similarly because of kids and families. And another one would be a grilling station. A lot of different apartment complexes have different rules on, they don't want someone having a gas grill on a 3rd floor balcony. And I mean, just for obvious reasons, right? And so the availability of amenities and the location of how to get places for us is very important. Going down to the expenses, I think expenses can be very difficult to underwrite, and so we lean heavily on the trailing 3 years of operating statements from that asset, and then any other information you can get from a broker and or any other property that you have any exposure to. If, for example, you call the broker up and say, hey, can I get some expense comps for this asset? What are you seeing other property management companies achieve in this market from an administrative load? That's like where your software would go. That's where your office supplies would go. Your phone service for your clubhouse would go. Advertising and marketing. If you're not marketing online, I don't know who you're marketing to. So we've seen a really big boon in some of our leasing just by using Craigslist. There's tools out there that will post your apartments on Craigslist every hour, and it costs like $100 a month. And we've seen a huge increase in leads because of that. So understanding your demographic and what internet services they use is really important. You go to a C-class neighborhood, they might not know apartments.com, but they use Craigslist. You go to an A-class neighborhood, and they might just be Googling or going straight from Safari on your iPhone to apartments near me, right? What they use is really important, and how you learn that is by asking the property manager when you do a tour. Payroll.
That's also just on the advertising, like that's a really easy value add, right?
Mm-hmm.
Too. Like if I toured an apartment last week and talked to the manager, and I go, how do you advertise? And it was 100% full, and she's like, we don't do a lot. Kind of signs, and I'll put some stuff on that Facebook thing, you know, and that was the extent of it. It's 100% occupied. So what that tells me is their rent's too low.
Yeah.
So I mean, that's an easy way to add value to an apartment. Just better advertising, getting online, getting on Facebook. Facebook ads are super cheap.
Mm-hmm.
And Google ads are still pretty cheap as well, but yeah, if you're not
Yeah.
online, like you said, like who are you advertising to?
Right. I mean, Facebook, that's a great one. I mean, when was the last time that any of you guys went to the second page of Google? I mean, ever in the last 3 years? I mean, so that's like, to your point, is like, if you're not, I mean, you pay for Google ads to be at the very top, but I mean, you talk a lot about in technology, the friction of using a tool. That's why kind of apps have had like kind of a run of like, I mean, just even the friction of using your phone and going out of their apps and like scrolling. It creates a less likelihood of you using that app. That's why mobile websites that go straight from Safari have had a boon, right? And so the ability to get information to people as fast as possible, whether it's Facebook, like understanding clicks, it's the same reason why Walmart, just kind of tying the conversation back to what we talked about at the very beginning, why does Walmart build where they build? Because they understand where all of the demand is because of the demographics. They're counting housetops. For us, you're looking at where do people go, what websites do they go to? And they go to Facebook more than they go to apartments.com. And so that might make sense and is a lower cost way of driving leads, specifically in small unit counts. You only need 8 people to rent, then your advertising becomes different. Payroll is really interesting. Actually, before I go there, are you guys more interested in hearing about the deals that we're doing, like 100 plus, or how does it relate to like 8 to 20 units?
Relatable stuff would be nice.
Yeah, 8 to, yeah, okay. That's what I figured. So payroll, I was just going to say, hey, the reason why I thought of that, hey, rule of thumb is every 100 units, you should have 1 in the office and 1 in maintenance. Well, that doesn't mean anything, right? And so I'll get my battery. What I think, from 8 to 20 units, what you want to focus on is, if you're not handy, which I am not handy, my wife actually is much more handy than I am, you need to know someone who can fix a water heater in the middle of the night. You need to know someone that you're going to call to fix the furnace who's going to charge you by the hour and not charge you $300 just to show up. And so when you're doing 8 to 20 unit deals, you need to know your vendor list well before you close. And that goes back into, in your due diligence period, you got to check the mechanical systems, you need to check the roof, you need to check the brick or the siding or whatever the building's made out of. You need to understand who are you going to call when something breaks. And that can save you hundreds of thousands of dollars, because the idea in all real estate is that you're not going to get any of those phone calls, right? Well, that never happens, right? And so then you got to understand, are you willing to accept a phone call at 3 a.m. where it says, hey, the second floor unit is spilling into the first floor unit? What are you going to do? I'll catch you guys tomorrow, I'm sleeping. No, that's not going to work. You're going to have residents for long, right? And so you need to have that plan of attack. A lot about the small unit deals is your logistics and troubleshooting, right? That's more important. Once you've vetted out a market and understand what rents you think you can charge, it's all about the operations. Even for us, we own 11,000 units. It's all about operations and how do you troubleshoot quickly. And so what that relates to is, if you're doing 8 to 20 unit deals, you better do them in a place that you can drive in 15 to 20 minutes. Because although you think that Lexington, Kentucky is just the sexiest market ever for whatever reason, and you're going to buy 8 units there, what are you going to do at 3 a.m. when someone calls and you don't have a local contact? Everybody is going to freak out. They're going to be calling you. They're going to want their security deposit back. They're going to want to move out, and you're going to be in this legal nightmare that you don't even know what to do. And so the ability to develop a relationship with folks and the connectivity and the availability to get to that asset is extremely important. And that's not just on small unit deals. I was telling Kent today, we were talking to somebody that wants to invest $20 million, and he was looking at a senior housing deal in Buffalo, New York. He lives in Columbus, Ohio. And the first thing we said to him is, how on earth are you going to be able to manage that? And he said, well, I think the cash-on-cash yield is going to be 9% day one. And it's like, no, it's not, because you have no idea how you're going to manage it. You have no idea how you're going to run that asset. And so even though you think pro forma it's going to be 9%, well, when everything goes wrong and it's 5%, you might as well have just bought the deal, the apartment complex that was just built and had a 5% yield, because you're effectively getting the same yield, but you're just taking way more risk. You understand what I mean? The ability to manage is a really, really big deal. O&M and turnover and landscaping, again, those are line items that go into what I was just talking about. 50% of people move out. O&M is who's going to do all the work for you when someone moves out, and you have a $300 security deposit from them, and they completely trash the place. And they moved out because they couldn't pay rent. Are you going to spend all of your time trying to sue someone that can't pay rent? That doesn't make a whole lot of sense. You're going to eat it. And it's going to cost you $1,200 to turn the unit, right? And so trying to figure out who can do all of that work, that's the most important part of underwriting small unit deals. Because if you're not the guy or the gal that's doing all of the work, you better find someone that can and figure it out.
I got a quick question.
Mm-hmm.
So when it comes to smaller units like that, when you find people who will come to your asset,
Mm-hmm.
how, I feel like there's not a whole lot of people out there that would do that for that small unit. So is it better for you to like learn to do that stuff on your own as well? Because I feel like they're not going to be wasting their time on a smaller unit when there's a lot bigger companies that work with bigger units.
Yeah, that's any of the stuff that's going to go wrong, it would be the same people that you would call to fix your house. So it'd be, hey, my furnace went out, and you call someone. I live on the west side, so I'd call Chapman Heating, right, and say, hey, and they charge you $100 to come out, and you want to, as much as you can, keep those guys on an hourly rate. So that they're incentivized to get the job done, right? To say, hey, I'm going to pay you to come out $100, and I need you to tell me within the first 30 minutes of what's going on and how many hours it's going to take. I don't want you sitting there all night saying, hey, I think you might need to get parts, and you know what? I went and tried to figure it out, and that didn't work. And so you've got to work with vendors that you trust and that are reputable.
Some of the guys I know that have, maybe they have like 50 or 60 units, but it's more like dispersed, so they don't have full-time property management. What they've done is develop deals like he's talking about with companies like a Chapman to get to even not an hourly rate, but like a fixed rate to say like, okay, like a water heater is $1,000. Water heater on this property, that property, it's always $1,000. And you kind of get to that point with those vendors, because then, one, it helps you understand what the costs are going to be, and two, it's you kind of build those relationships, and they'll because you're giving them all the volume, they'll go at 3 a.m. and do that.
Mm-hmm.
I want to say one thing, but I know from personal experience, whenever I have issues like that, if you've already been networking like at Salary or stuff like that, you'll find contractors, but then just ask other people who have property who they use. And then also, let's say something small like a unit
Mm-hmm.
that normally when you walk through the first time, you can ask that owner or seller, like who's the contractor, basically. Who's the guy that helps you fix your stuff? And then after you buy it, you build relationships with them too.
Yep.
It doesn't have to be like $1,000 for a water heater, right? But it can be a lot more cheaper, especially when you build that relationship with them.
Like if you could find like a handyman guy, that's the best thing, kind of like
Yep.
jack of all trades guy who can do a bunch of stuff, for you. It's kind of your guy. Like that's probably the best thing. I mean, you're not things like HVAC. You're not going to be able to do that. It's not all you have that skill set.
Mm-hmm.
But if it's stuff just like fix a leaky toilet, stuff like that, that's
Right.
the stuff. Like you don't. Like you asked earlier, like should you learn how to do that stuff? Depends on what your business plan is, but like if you really want to scale up to any size, you can't be fixing toilets.
Right.
You gotta find somebody that's gonna do that for you.
Mm-hmm.
And I'm sorry I missed it because I was late coming in, but I don't know beforehand if you, I know you mentioned you were at JLL and then jumped to
Mm-hmm.
B&H. Like that's such a different, like these guys are buying such bigger assets that like they don't know when an HVAC, I mean, correct me if I'm wrong, but they don't know when there's a plumbing issue or something like that. But like from personal experience in buying like these 8, 10, 15 unit properties, like I've done the self-management and it sucks, man. So like if you can find a good management company, and it's very tough to do on those type of properties because there's not a lot of management companies that will do that. Usually you're in that C-class space. The rents aren't very high, right? So it's not very lucrative for a property manager. But if you can develop a relationship with somebody like that, and having that kind of arm's length, it's so much better than getting because I've gotten those calls. I mean, we were in Hawaii one time and like somebody's they've gone in and that one of the units, the electrical work was like it wasn't working. Well, they need an electrician need to go in and flip the switch. And it's like stuff like that where it's your time is worth so much more, and that's why when Ken's talking about economies of scale, it makes so much more sense to go bigger. Right. You get these guys who are like, well, I'm gonna go buy 4 units and 8, and they get all these properties rounded up, and then they can't have any, but like they don't have any management structure. So back to his
Yeah.
point of like operations, it's so crucial like troubleshooting and getting stuff done because you'll have tenants who will you'll have a mass exodus.
Yep.
I've seen people do creative solutions with like virtual assistants to have like them be effectively like be your call center. So you give your virtual, like you go to Upwork, you find a virtual assistant, you pay them $5 an hour, and they have your list of all your contractors, right? So they get the phone call or email, or it's pretty cheap, like property management software, some of them are free, like Cozy. We can do maintenance requests. They'll go to that person, they'll call the electrician if it's an electrical problem for you, and then get the person out there. And so you're not the one that has to be that interface.
Right,
Mm-hmm.
And it's not that expensive.
Yep. No, I think that's really good. That's it. I mean, no, I don't know when water heaters and stuff go down, but because we're 300 employees and 270 of them are working to troubleshoot. Not only the people on site, but the people that are on site report to make sure. And so, just as a company of our size, 90% of the people are focused on operations, and it's just such a key because this management fee in our business is anywhere between 2.5% to 4%. In the small unit deal, you're probably talking like 6 to 10%, maybe 12%. But 12% of $10,000 of revenue is $1,200. But if you're talking 1 month down for a unit because you can't get someone to fix or you can't troubleshoot it, it's already, it's gone, right? And so it's not really, it's just exactly what you mentioned. And Ken talked about it's economies of scale. I know we don't have a ton of time, but I was thinking I can jump in to Excel or I could just draw it on the board and just like, would it be helpful to see like, hey, here's how I would start an underwriting model from scratch? I've got like a 50 tab underwriting model, but I don't know that that's going to be exactly what we want to dive into. So it's like, and as a historical thing, when I was getting into trying to figure out underwriting deals, there's something called Urban Land Institute, ULI for short, and it's a real estate. It's all around the nation. I think it's even global, but they have on urbanlandinstitute.org or whatever, they have underwriting classes where it's $300, and I think what's really cool about it is And I don't know if they have any multifamily ones. I was doing commercial at the time, but I sat in my apartment at the time and had one screen up with the presentation because it was taped, and I had another screen up in my own Excel because that's what they told you to do. And it's like, hey, walk through this with me and build your own underwriting model. That's how you underwrite. You start to build a model and then understand exactly how. And the funny thing is, I took that model, and it's actually still being used today at Birge and Held on the development side. It's a much better version of what I built in my apartment, I can tell you that, because the one that I built was not awesome. But it's just the fact of like start doing it, right? And so like getting into, it's like, okay, I got a blank canvas. I have no idea what on earth am I going to do. And it's like, okay, you just make it as simple as this, like income. You create an operating statement, like expenses, blah, 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 right? And you just have expenses 1, 2, 3. And you start to build something to where it's like, okay, how am I going to get my income? Would you guys rather me talk about the deal that I was going through or just like continue to do this? I mean, does everybody have an Excel underwriting model that they already have? And they're just like, dude, like what in the world? Like, this is easy. I mean, so if you don't, and this is what we were talking about, like, this is how you would start doing it. And so let's just say, hey, this is my operating statement, okay? And then this is my unit mix, okay? And this is my 10-year cash flow model. And then I have a amortization schedule. An amortization schedule is essentially how you get debt and you are going to pay it off over the next 20 years. And so it's a really easy thing to Google on how to build an amortization schedule. I honestly, that's what we do still, because there is a million formulas you can write in Excel, and you only know like the 7 that you do every day. And so unit mix, okay. This is the floor plan type. Number of units, and I'll just so hey, we have like 1, 2, 3, 4 floor plan types, right? And there's 2 of these units, there's 4 of these units, there's 2 of these, and there's 3 of these. And the rent is 1,000, 1,100, 1,200, 1,300. Okay, and so you get that's your total rent that you can achieve. And so then you try to figure out by rent by unit type, right? Ken, is this okay with the remaining time?
Yeah.
Is this just for I mean?
No, I'm good with it. I think this is helpful for people. I mean, without an Excel model, we don't have much.
Yeah, I mean.
To really understand it.
Yeah, and ask as many questions as you want. I'm not really looking up as much, but like now I have a rent by unit type. That to tie them all together is a really rudimentary level of this, right? It's the exact same thing. Now all of a sudden I've got my rent. That's my maximum rent I can get. And so what I would do here is say, oh, here's my income. Here's my top line income that I could do. And all of this data is informed by all the stuff that we spend all the time talking about. Is like, hey, here's the current rent that they're achieving, right? Then you say, okay, that's the current rent. Here's my rehab rent. Well, I'm going to do such an awesome thing. I'm going to spend $10,000 a unit. I'm going to raise the rent $200, right? And so what you could do is just build in. You want to make everything dynamic, right? So you have as few inputs as possible, okay? So that's your rehab bump, and you have your rehab rent. And what I mean by dynamic is in Excel, you can just set formulas to do everything, right? So where now you can just change the text color to blue or whatever to show, hey, these are my manual inputs. Everything else is formulas, okay? So then this should be blue as well. Blah, blah, blah. But then what happens is you start to then build in a 10-year cash flow model. Hey, not only am I not getting $1,200, I think I can get mm, I can get 14,900, okay? And so then you start to build out, okay, here's my day one operating statement, okay? That's what I was showing you guys earlier. This is day one. The next tab that we have is year one. And you can see at the top here, the gross potential rent changes over the first month or over the first 12 months because we're doing rehabs and we're increasing the rehab rent and we're building that table that I was just showing you. And so then you start to look at here, our gross potential rent in year one is 1.1 million. Our gross potential rent in year 5 is 1.3 million. That is the only way that you can make money is increasing rent. You can either increase rent or you can reduce expenses. And if you're here to try to learn ways to reduce expenses and make a ton of money, you're in the wrong place, okay? And there's just no way you're gonna make a ton of money doing that. And so what you wanna do is you wanna figure out through your underwriting model is, I mean, these are the only 4 tabs you need. You don't need anything else. You need to know how much debt you're gonna get, and you need to know how you're gonna pay that off through your amortization schedule. You need to know what your day one operating statement looks like. You need to know what your unit mix looks like, and you want to know what your 10-year cash flow model looks like, because that's how you're going to get investors. Go ahead.
Aaron, what's the most common exit strategies that you guys use?
Yeah, so we've sold 19 deals, and we've held them for 4 or 5 years on average. And the exit strategy for us is if we've already completed the business plan and we've held it for 4 or 5 years, and we don't want to renew our debt for another 10 to 12 years, and we want to create a liquidity event for ourselves and our investors. Our exit plan is to take it to market. And so I think on a smaller unit count, I think you probably want to look at even a shorter time horizon, because a lot of what your hold period is going to be driven off of is the kind of debt that you have. You drive down the street to your local bank and you say, hey, I need a non-recourse loan, which means you don't have to guarantee it, and I need it for 10 years. And they're going to say, well, how much money do you have with us? Well, I've got $7,500 in your bank. And we're like, well, best of luck. See you later, right? And so it's like developing relationships with not only investors, but also bankers to understand how are you going to finance this, right? And so you might have a 5-year term loan. So you better execute your business plan faster than 5 years, because you want to reap the rewards of high cash on cash returns as fast as possible.
So this is something that we had talked about before, I think previous one, but yeah, if you're with a commercial bank, if you have a smaller deal and you have to go to the commercial bank, like, it's always going to be a recourse loan. They'll never, the only time you'll ever not have the person sign for it is if you're putting like 50% down. Like at that point, like you do this for the leverage. That's why you're investing in real estate, because you can leverage it. So don't put 50% down. Is that one? So what you want to do is, like, that's why there's benefits to being in a deal the size where the loan amount is greater than $1 million, because it'll open up agency financing to you. One of my favorite products is like the Freddie Small Balance loan product, because you don't need pre-existing experience. The fees are like a third of what they are if you try to go like on a conventional loan, like these guys are doing on the big stuff. And they'll give you a 30-year amortization, which no commercial bank will, meaning each month your payment is going to be lower because you spread it across more time. It's non-recourse, which is huge. They'll also give you interest only. So they'll give you a 10-year fixed, and they'll give you the first 3 years interest only, which helps your cash flow in those first 3 years as you're trying to returns and things, or you're just trying to pay your investors. So there's definitely a value in getting to that, like your loan value is above $1 million, because it opens up just a whole new world of financing for you. That's a lot easier to deal with than your typical commercial bank.
Mm-hmm. Yeah, that's exactly right.
I'm sorry, this is a question more towards like your guys' business model and just kind of the environment that we're in right now. Like, I saw on some of your, I guess it's a two-part question, but like, I saw some of the sponsor guarantee fees and whatnot. Can you walk through, like, 2.5%, that's great, but can you walk through some of your waterfall? And on top of that, with the environment that we're in, and you see a lot of these, like, kind of pop-up syndicators and whatnot, what does that look like for your guys' business model and competition-wise, and some of these people who are, may not have been around as long as what you guys have? How are you guys kind of, I guess, confronting that
Sure.
with your investors?
Yeah, that's interesting question. For us, the sponsor acquisition fee that we take ranges from 1 to 2.5% based on the deal size. And something that I think is very important is, in speaking to investors, is that you roll that fee in to the extent that you can, to where then you are side by side, and that creates alignment from day one. I mean, it's really difficult on this deal for us to take a fee of $210,000 and we're raising $3 million from investors to say, thanks guys, really appreciate it, hope the deal goes well, right? If we roll the fee in, or if you roll your fee in, then the investor feels like, hey, they're in it with us. I mean, they're gonna the good and the bad, and so I think that's a really important piece before I get into the waterfall.
Can I add a comment, just
Mhm.
as a personal passion of
Yeah.
mine, is that, like, the most dangerous person to invest with is the person that needs those fees to pay their mortgage and their car. Because they're not incentivized to put you into a good deal. They're incentivized to do a deal because they have to pay their mortgage and their car.
Yeah, that's
So,
exactly right.
They're gonna tell you whatever they need to get your money, to give them their money so that they can
Mm-hmm.
they can live on it. So
Yep.
so it's like, and I say that because I think you do need to understand, the economics of the person that you're investing with. But there are a lot of people that have done that, right? That have kind of left their job and started syndicating, and I've started syndicating. I still do other work on the side though. I don't need your fees to pay my mortgage, but so it is a balance. I'm not saying like write the person off totally, but like just understand how incentives move people, right?
Mm-hmm.
And what that means, because if they need the fees, it means they've got to do deals.
Yep.
And with the market that we're in and the place we're at in the cycle, we're in a very mature market, right? Cap rates are low, prices are super high. It's tough to find a deal. I mean, how many deals do you guys look at before you find one that you go after?
Probably 20 to 40. I mean, we did 12 deals or so last year, and we probably underwrote. I mean, we'll have a couple summer interns every summer where all they do is underwrite deals. The guy probably underwrote 200 deals.
Yeah.
In a couple months.
My point is like, if Joe Schmo syndicator is bringing deals every couple months, doesn't have an infrastructure like these guys, like just be wary of the deals and what they're promising you.
Yeah. No, that's exactly right. And I think to side saddle onto the preferred return and the waterfall, right? So we offer anywhere between a 6 to an 8% preferred return. And Kokomo is an 8% return because Kokomo inherently should be a little bit riskier than Indianapolis. Back to the same reason why Indianapolis should be a little bit riskier than Denver. It's simply just law of numbers. There's more people that live in Indianapolis than Kokomo. And so the demand for housing should be lower, right? And so that yield to the investor, so that investor gets paid first, and then anything above the 8% split 70-30, 70 to the investor, 30 to us. And so we don't do IRR hurdles unless we're working with single source capital. I think on small syndications, cash on cash return is the simplest way. Again, like one of the first things I said, keep it simple. And then what was the second part of the question?
Just like kind of what Cam was talking about with some of the syndicators that are like, kind of bringing in more money just to kind of grab a fee, right? You see a guy that he knocks down a couple $1 million deal and walks away with a 3.5%, 4% acquisition fee.
Right.
Like, not that you guys are necessarily competing with a lot of those people,
Mm-hmm.
but I do think that they're out there.
Yep.
And that's part of my question is like, is
that just more work you guys have to do in trying to sort through some of those things, or
Yeah,
how are
that's
you approaching that?
so the way that we're approaching it mainly is, I mean, we're weeding a lot of that out based on the deal size that we're working with. But honestly, it's hard to weed those kind of guys out until you have a track record, right? And so it's kind of, I mean, it's kind of a, I mean, that's the first thing I would look at when you see someone that's syndicating a deal. Is how many deals have you syndicated in the last 6 months, and can I get the current financials in the pro forma? So let me see what you've actually been able to execute. And then if you see the fact that 50% of his deals aren't even paying current, and he actually doesn't even manage any of them, I think that's how you start to, and the way that we're doing it is based on deal size, but then also is broker relationships. And so the fact that someone is going out and syndicating, doing those deals is great. I think it's awesome. But for us, it's developing that broker relationship to where we get a last look at a deal in our market. I think to kind of finish up, and I probably should have started this earlier rather than talking about a deal that we've done, is this Excel model. Kent mentioned it was one of the very first things, and he's exactly right. And we just talked about how many deals we underwrite to win one. You've got to figure out a way to develop that tender model of where you can like size deals up extremely quickly. And so what you need to do quickly and understand is have the same base case model, and then just have a file of every single one of those models to where you're always looking in the same spot. As much as you can hone in on what your Excel model looks like, and as simple as you can keep it, to where you just have certain number of inputs where the only thing you're toggling is purchase price, rent bump, CapEx plan, and you can put all of those inputs in the same tab, and you just put in also the debt amount and the amortization period. Like, just go Google like how to build an amortization schedule. If you can just get your model down to be like 8 inputs, and you can quote unquote desktop underwrite a deal in 20 minutes, that's how you're able to do deals, and that's how you're able to leverage your time. And you don't ever get caught in the thought that you're going to get a perfect underwriting model. The people that perfectly underwrite never do any deals, okay? And so what you want to do is focus on just getting yourself into the position to make a good offer as fast as possible. And you're always going to miss stuff. No, I've never done a deal where I didn't just miss something. Some of them are obvious, some of them aren't. And there's a lot of work that goes in on the front end. There's a lot of information out there, and we talked about some of it. But getting a really simple Excel model that is clean and you can send off to an investor and it's easy for them to go through, I think is just the most important part. And so I think really what you're looking at the end of the day is this 10-year cash flow model. What's your average cash on cash return every year? What's your IRR if you want to look at that, and to understand how to measure. We talked about gross rent multiplier earlier. There's always some of these stock metrics, those being 3 of them, that you want to just be able to sort through deals and understand that it's not just the highest number is the deal that you should do. You underwrite a deal in Kokomo, but you live in Evansville, and you underwrite it to be a 12 cap, and it's a 15% cash on cash return, and you choose to do that deal over a deal that's in your backyard that will cash flow 8%, you better have a really good justification of why you're doing a deal 4 hours from your house other than the one down the street.
Yeah, that's like risk-adjusted return we talked about, right? Like you can't just look at the return flat out, because I'll sell you deals in Southside Chicago all day. They'll tell you you're going to get a 14% cash on cash. The reality of the situation is what's your bad debt going to be and how you're going to collect that rent, right? So it's all risk adjusted, right? You got to look at everything and what can you actually do, and I think the point of being drivable is really important.
Yep. For us, at a company our size, that was the number one thing. The worst deals we've done are probably the farthest from home in new markets where a company of our size is trying to build out a brand. Nobody knows who you are or why in a different market. And so it's going to be harder for you to get a deal because of those broker relationships. And it's also going to be harder for you to execute because you don't know the vendors. And it's going to be harder for you to know who to hire on the property management front. And so until you've absolutely struck out of all of the deals that are in your backyard, then I would say keep looking. And there's no replacement for windshield time. You think you know your neighborhood? We'll drive around for 3 hours and just drive every street, and then you start to really understand why people live where they live. And it's all about connectivity to jobs, school systems, and so I think there's no replacement for that. I'm open for questions.
I just have like a random comment. So Aaron mentioned a $300 kind of training that he went through for building a financial model. There is available online some that will be like first time person or first time learner, whatever deals, and I was able to get a similar level course, and it was like $10. So they're out there, and I was also, the second part to that was I got my original model from a friend when I did my first deal, and so I just plugged it into theirs. What kind of value do you put into creating your own model, even if it's just for like the learning?
Yeah, a lot of value, because you never know what someone's going to ask you. If you're spending your own money and you're going to buy a deal with your own money, and who cares what model you've got, other than like for your own comfort. Building the model and understanding your own model and understanding all of the inputs, you actually doing it, not as important as you actually understand how everything flows together, because it becomes very easy just to say, hey, I got a buddy's model, saying that you did this, but I got a buddy's model, there's 8 inputs, okay, hey, it says good. Well, you didn't understand the fact that, on the other tab, I should have changed the debt because that's not how much money we're getting from the bank, right? And so it doesn't matter if you authored it or not. It's more important about understanding all the inputs, how they're connected together, because that's still a majority of what I spend most of my time doing, is explaining underwriting models to institutions of why we made the assumptions that we made. And that's where keep it as simple as possible and be ready to defend your assumptions with market data, and you'll be in a good position.
Yeah, the assumptions are more important than the model. I probably have 6 different models. Some are that have gotten to deals. Some are super complicated, or sophisticated, I would say. Because they come from institutions, and I'm like, oh yeah, this is gonna be awesome. This is gonna be the best underwriting ever. The time I spent to understand the model was so much greater than if I would have just built it on my own. It's harder to re-engineer someone else's and understand what's going on and all the links between things than to just do it on your own. And honestly, that model, the most complicated one I have, it has way too much. You can't even, there's a summary page with probably 50 different metrics. By the end of it, you're like, hey, this one's telling me it's good, this one's telling me it's not, this one's telling me it's okay, this one's good, not. It's like, I don't really know at the end of the day.
Yep.
So
yeah, that's exactly right.
I agree that simpler is better, and I think the assumptions matter more than the actual model.
I agree.
When you guys meet, like at Birge and Health, I see you guys pick these apart sometimes in the office. And how does that process work? What is your checks and balances? Are there certain assumptions that you guys really debate back and forth on more that give a little bit more weight to?
Yeah, rent's number one. Especially as you get into the higher number of units, the ability to we own Lakeshore Apartments at 82nd and Allisonville, and it's 740 units, and the depth of a market for the number of families that can absorb a rent bump becomes a pretty hot topic. I mentioned that we did a few deals in Fort Wayne. Our first deal that we did in Fort Wayne was 450 units, and we purposely did 2 different rehab levels because the neighborhood that it was in, we didn't trust that 450 families could afford the rent bump that we were talking about. And so understanding not only what the rent bump should be, but how many people can afford that rent bump, because it becomes a different underwriting model. I said, like, these 4 tabs you absolutely need. You also need to understand or have a tab that if you're going to do a rehab, of when are you going to rehab the unit and how long is that unit going to be offline and not paying rent, and that needs to factor into your vacancy, because you can't go in and do a rehab and move people out purposely and think you're going to be at your terminal occupancy. That doesn't make any sense. And so the rent, and then also what will occupancy be for that rehab period becomes the 2 things that we can test probably the most. The other one is payroll. It takes a lot. I mean, for us, we pay property managers $40,000 to $60,000 a year, and they're managing an asset that's worth $20 to $100 million. It's very unique for our industry, and it can cause some really bad things. I mean, I think $40,000 to $60,000 is a median wage for the United States and is a good wage, but most people that are making that aren't managing an asset that could be worth $100 million. And it becomes very complicated. It becomes a leadership thing. And so when we as the underwriting team start to skimp on payroll and say, hey, we'll just hire people and they'll run it, that's where the operations team starts to push back a lot. Everything else is kind of hard. The rehab plan we talk about a fair amount of why does this asset need granite and this one doesn't. So we didn't talk a lot about tonight, honing in on your rehab scope, but understanding who is going to do the work, how much it's going to cost, and how much time it's going to take them to do it is very important, especially on small unit counts. I think someone mentioned it earlier about the availability of finding labor to do the work. And you had mentioned about, hey, should I learn how to do it on my own? I think that's a good thing for some stuff. I obviously can't talk about scaling it, but it's hard to find labor to lay flooring in one unit, or to fix it or replace the countertop, replace all the cabinets, whatever. And so you've got to be willing to upspend to make sure it gets done in 2 weeks or in a week, versus paying your buddies with a case of beer and they get it done in 45 days. Because if you saved $700, but your asset was offline for an extra month, well, you just lost $1,000 in rent. So was it really worth the $700 that you saved? Those are the contemplations that you have to have, and Matt, even at the deal size that we do, as we talk about that a lot.
Any more questions? No? Thanks, Aaron. Appreciate it.
Yeah, absolutely.